Consumption has been one of the big drivers of the economy. But in the past year, there have been signs that people are spending less. And malls like this one, real estate developers and car manufacturers have been feeling the pinch. Now, while one key factor has been inflation, industry leaders say interest rates have also played a role. Now, this Monday, India's central bank, the RBI, will meet to review its monetary policy. The bank has already cut lending rates 3 times this year, but with inflation easing over the past few months, many want a further reduction in lending rates to help trigger consumption and business investments. We asked industry and analysts what they expect from the RBI.
From the point of industry and business, we are very, very clear. We would like a much lower rate of interest, maybe 100 to 200 basis points should be brought down. And I think this is the demand of industry in view of the fact that we need cheaper money in order to take things forward. On the other hand, we have the issue of inflation. We have the issue of rising prices in terms, and with the exchange rate being what it is, we are going to have a lot of other difficulties which also come our way.
Private sector investment in infrastructure is highly dependent on interest rates. It is very sensitive to interest rates, I should say. So the returns of developers depend to a large extent on interest rates. So in almost all the sectors of infrastructure today, there is a problem in the sense that because of policy issues, because of the issues of the developers, corporates, the interest in infrastructure sector has considerably come down, and this is a cause of concern, and therefore we have to make sure that this interest is revived.
It's very unlikely they will cut rates at the June review. I think the dominant factor here is going to be the exchange rate. As you know, the Indian rupee has depreciated very sharply, probably in line with many emerging markets with current account deficits for global reasons, not for India-specific reasons. But in the last couple of days, the depreciation has been even worse than some of the other emerging markets. So when your currency is falling so sharply, despite the growth inflation dynamics, I think to be seen to be cutting rates by a central bank would be a very dangerous strategy.
The inflation decrease, at least the consumer inflation, seems to have stopped. So it's still at around 9.3%, which is way above the 5% level. A weakening rupee. And thirdly, there's been some outflow of foreign money, especially from the debt markets. So given this, I think the confidence that whether the central bank will cut rates is not there. I mean, because of these new developments. It is possible that the central bank may wait for 1 more month before doing a rate cut.
India's national carrier has faced turbulent times over the past few years, struggling with huge debts and labour unrest.